Making the decision to sell 80% of physical silver holdings to reallocate capital into silver mining stocks represents one of the most significant portfolio shifts in recent years. This isn't speculation or market timing based on short-term price movements. This strategic reallocation reflects fundamental changes in market structure, macroeconomic conditions, and risk-reward relationships that favor mining equity exposure over physical metal ownership during specific market phases. Understanding the rationale behind this decision requires examining the mathematical relationships between physical precious metals and mining companies, the current macroeconomic environment, and the leverage dynamics that create superior return potential in mining stocks during favorable conditions. The relationship between physical silver prices and mining stock valuations operates through leverage mechanics that most investors don't fully understand. Mining companies represent leveraged plays on underlying commodity prices because their profit margins expand exponentially when metal prices rise above production costs. A silver mining company with production costs of $15 per ounce generates modest profits when silver trades at $20, but experiences dramatic profit expansion if silver reaches $30 or $40 per ounce. This leverage effect creates mathematical relationships where mining stocks can appreciate 3 to 5 times faster than underlying commodity prices during favorable market conditions. However, the same leverage works in reverse during unfavorable conditions, creating volatility that requires careful risk management and strategic timing for optimal results. Understanding these dynamics becomes essential for investors considering allocation shifts between physical metals and mining equities. Current macroeconomic conditions create particularly favorable environments for mining stock outperformance relative to physical metals. Central bank monetary policies worldwide are shifting toward accommodation after extended periods of tightening, creating liquidity conditions that historically benefit risk assets, including mining stocks, more than physical commodities. Additionally, mining companies have improved operational efficiency, reduced debt levels, and enhanced capital allocation strategies during recent challenging periods, positioning them for superior performance when commodity cycles turn favorable. The Federal Reserve's evolving monetary stance indicates growing concern about economic growth prospects and employment conditions that typically prompt policy accommodation through interest rate reductions and quantitative easing programs. European central bank communications reveal similar concerns about regional economic weakness, requiring additional monetary support. Bank of Japan continues aggressive accommodation despite global tightening trends. These coordinated policy shifts create liquidity expansion that benefits equity markets generally and mining stocks specifically. Mining companies offer several strategic advantages over physical metal ownership during the current macroeconomic environment. First, mining stocks provide exposure to operational leverage where profit margins expand dramatically when commodity prices rise above production costs. Second, well-managed mining companies generate cash flows that can be returned to shareholders through dividends and share buybacks, providing income streams that physical metals cannot offer. Third, mining stocks can benefit from broader equity market momentum during periods of monetary accommodation and risk asset appreciation. The operational improvements within the mining sector over recent years create additional advantages for equity investors. Major mining companies have reduced production costs through technological improvements, operational efficiency gains, and strategic mine development focused on higher-grade deposits. Debt reduction programs have strengthened balance sheets while reducing financial leverage that previously created risks during commodity downturns. Enhanced capital allocation strategies prioritize shareholder returns over aggressive expansion projects that historically destroyed value during cyclical peaks. Silver mining companies specifically benefit from unique supply-demand dynamics that create advantages over other mining sectors. Silver supply faces constraints from declining ore grades, permitting challenges and limited new mine development that restrict production growth even when prices provide economic incentives. Industrial demand for silver continues growing through renewable energy applications, electronics manufacturing, and medical device production that create baseline demand regardless of investment flows. The leverage calculations for silver mining stocks become particularly attractive under current conditions. Leading silver mining companies trade at valuations that assume silver prices remaining near current levels or declining, creating asymmetric risk-reward relationships where upside potential significantly exceeds downside risk. If silver prices advance 20 or 30% from current levels, mining stocks could appreciate 100 to 200% based on historical relationships and operational leverage dynamics. Specific company analysis reveals opportunities among established mining companies with proven reserves, efficient operations, and strong balance sheets that provide both growth potential and defensive characteristics. Companies with diversified geographic operations, multiple mine sites, and exploration pipelines offer additional advantages through operational diversification and growth optionality that pure silver exposure cannot provide. The timing considerations for this allocation shift reflect multiple converging factors, including technical price patterns, monetary policy evolution, and mining sector valuation metrics that collectively suggest favorable conditions for mining stock outperformance. Technical analysis of both silver prices and mining stock indices shows constructive patterns that historically precede periods of outperformance for mining equities relative to underlying commodities. Monetary policy timing appears particularly favorable because central bank accommodation cycles typically benefit risk assets, including mining stocks, before precious metals. Prices respond to currency debasement concerns. This sequencing creates opportunities for mining stock appreciation during early accommodation phases before physical metal premiums reflect monetary policy impacts. Understanding this timing differential enables strategic allocation adjustments that capitalize on phase relationships between different precious metals investment approaches. Market sentiment analysis reveals mining stocks remain undervalued relative to both historical norms and current commodity price levels, creating entry opportunities at attractive valuations. Professional investor sentiment toward mining stocks shows significant pessimism despite improved fundamental conditions, creating contrarian opportunities for investors willing to position ahead of sentiment improvements. Retail investor attention remains focused on physical metals rather than mining equities, providing additional contrarian signals. The risk management aspects of this allocation shift require careful consideration because mining stocks exhibit higher volatility than physical metals while providing potentially superior returns during favorable conditions. Position sizing becomes critical because mining stock volatility can create substantial temporary losses that test investor conviction during adverse market phases. Diversification across multiple mining companies and geographic regions provides risk mitigation while maintaining upside exposure to favorable sector dynamics. Currency considerations affect both physical metals and mining stocks, but create different risk profiles that influence allocation decisions. Physical silver provides direct currency debasement protection, but generates no income and faces storage costs that reduce total returns. Mining stocks offer indirect currency protection through commodity exposure while generating potential income through dividends and providing operational leverage to commodity price movements. The international diversification benefits of mining stock investments create additional strategic advantages over concentrated physical metal holdings. Mining companies with operations across multiple countries provide geographic diversification that reduces political risks while maintaining commodity exposure. International mining stocks also offer currency diversification benefits and exposure to different monetary policy environments that can enhance portfolio resilience. Operational leverage analysis reveals why mining stocks can significantly outperform physical metals during favorable commodity cycles. Mining companies with production costs below current silver prices generate substantial cash flows that can fund expansion projects, debt reduction, and shareholder returns. As silver prices rise, these cash flows increase exponentially because revenue increases while fixed costs remain stable, creating dramatic profit margin expansion. The mathematical example illustrates this leverage effect clearly. A mining company producing silver at $15 per ounce with silver trading at $25 generates $10 per ounce in gross profit. If silver prices advance to $35, gross profits double to $20 per ounce, representing 100% profit increase from a 40% commodity price advance. This operational leverage creates the return multiplication that makes mining stocks attractive during commodity bull markets. Capital allocation strategies among mining companies have improved significantly during recent years, creating additional value for equity investors. Companies now prioritize cash flow generation over growth at any cost, leading to more disciplined exploration spending, selective mine development, and enhanced shareholder return programs. These improvements reduce the historical tendency of mining companies to destroy shareholder value through poorly timed expansion projects during commodity peaks. Dividend policies among mining companies provide income generation opportunities that physical metals cannot offer. Well-managed mining companies with strong cash flow generation implement dividend policies that provide steady income streams while maintaining financial flexibility for operational requirements. These dividend payments can compound investment returns over time while providing partial protection during periods of commodity price weakness. The exploration upside potential in mining stocks creates additional return drivers beyond operational leverage to existing commodity prices. Mining companies with strong exploration programs and promising development projects offer exposure to reserve growth and new discovery potential that can generate substantial value creation independent of commodity price movements. This exploration optionality represents significant additional value that physical metal ownership cannot provide. Environmental, social, and governance considerations increasingly influence mining company valuations as investors focus on sustainable operating practices and community relationships. Companies with strong ESG profiles often receive valuation premiums while accessing capital at lower costs, creating competitive advantages that enhance long-term investment returns. Physical metal ownership avoids these operational considerations, but also forgoes the potential benefits of well-managed mining operations. Technology adoption within the mining sector creates operational efficiency improvements that reduce production costs while enhancing safety and environmental performance. Advanced mining technologies, including autonomous equipment, predictive maintenance systems, and optimized processing techniques, enable cost reductions that improve profit margins at any given commodity price level. These technological improvements provide structural advantages for mining companies that physical metal ownership cannot capture. The merger and acquisition activity within the mining sector creates additional return potential for equity investors. Consolidation trends drive premium valuations for attractive mining assets while creating operational synergies that enhance combined company performance. Well-positioned mining companies become acquisition targets during favorable market conditions, providing exit opportunities at premium valuations that physical metal ownership cannot access. Financing considerations favor mining stock investments during current market conditions because improved company balance sheets and operational performance enable access to capital at reasonable costs. Strong mining companies can fund expansion projects and operational improvements through debt or equity financing when opportunities arise, creating growth potential that exceeds what commodity price appreciation alone can provide. The political risk considerations differ significantly between physical metals and mining stocks, requiring careful evaluation for international portfolio allocation. Physical metals provide complete protection against political risks in mining jurisdictions, but face confiscation or taxation risks in storage locations. Mining stocks face operational risks from political changes in mining jurisdictions, but offer diversification across multiple locations and the ability to adapt operations to changing political environments. Tax considerations influence the choice between physical metals and mining stocks based on individual investor circumstances and jurisdiction requirements. Physical metal ownership often receives favorable tax treatment as capital gains rather than ordinary income, while mining stock dividends and capital gains face different tax rates depending on holding periods and investor tax status. Understanding these tax implications becomes important for after-tax return optimization. Liquidity considerations favor mining stocks over physical metals for investors requiring flexibility to adjust position sizes or exit investments quickly. Mining stocks trade in liquid public markets with transparent pricing and immediate execution capability, while physical metals face transaction costs, authentication requirements, and timing delays that can complicate portfolio management during volatile market conditions. The storage and insurance costs associated with physical metal ownership create ongoing expenses that reduce total investment returns over time. Mining stocks avoid these carrying costs while potentially generating income through dividends, creating total return advantages that become significant over extended holding periods. These cost considerations influence long-term investment attractiveness calculations. Professional investment management capabilities differ significantly between physical metals and mining stocks because active management can add value through company selection, timing, and risk management in mining equity portfolios. Physical metals offer limited management opportunities beyond timing and allocation decisions, while mining stock portfolios benefit from fundamental analysis, operational due diligence, and active portfolio management techniques. The correlation analysis between silver prices and mining stock performance shows that while mining stocks generally follow commodity price trends, they can outperform substantially during favorable conditions while underperforming during adverse periods. Understanding these correlation patterns enables strategic allocation timing that capitalizes on periods when mining stocks offer superior risk-adjusted returns relative to physical metals. Market structure changes, including the growth of exchange-traded funds, increased institutional participation, and algorithmic trading influence both physical metals and mining stocks differently. These structural changes create new opportunities and risks that affect optimal allocation strategies while providing enhanced liquidity and transparency in both market segments. The psychological aspects of holding mining stocks versus physical metals create different investor experiences that influence long-term investment success. Physical metals provide psychological security and tangible asset ownership that appeals to investors seeking portfolio insurance against financial system risks. Mining stocks require comfort with equity market volatility and corporate operational risks, but offer superior return potential during favorable conditions. This strategic allocation shift from physical silver to mining stocks reflects careful analysis of current market conditions, macroeconomic trends, and risk-reward relationships, rather than emotional decision-making or short-term speculation. The decision incorporates multiple factors, including operational leverage dynamics, improved mining company fundamentals, favorable monetary policy evolution, and attractive relative valuations that collectively suggest superior risk-adjusted returns from mining equity exposure. Risk management remains paramount during this allocation shift through careful position sizing, diversification across multiple companies, and maintaining flexibility to adjust positions as conditions evolve. The allocation strategy includes predetermined criteria for reducing mining stock exposure if conditions change unfavorably, while maintaining core conviction positions in highest quality mining companies with strongest competitive advantages. This analysis examines strategic portfolio allocation considerations rather than providing specific investment advice or guaranteeing future returns. Individual investors must evaluate their own risk tolerance, investment objectives, and financial circumstances when making allocation decisions. Understanding the dynamics between physical metals and mining stocks provides framework for making informed decisions while recognizing the inherent uncertainties in market timing and investment outcomes.